stock is down. It must be something bad. That's how everyone thinks during earnings season. It's like one big echo chamber. It's astonishing to watch. Far more often, it's totally backward. If a stock is down, you might be better off assuming it's a buying opportunity. I know that sounds like a really ridiculous orthodoxy, but it sure makes sense when I see, like, on my screen, the banks and what's going on. Take Goldman Sachs, a company I worked at, know very well, one reason we own it for the Chapel Trust. Whenever I get with fellow Goldman alums, and I do, or current members, I do that too, among the first things that come up after you talk friends and family is how cheap the stock is. Remember, lots of people use really sophisticated metrics involving return on tangible equity and the efficiency ratio to measure banks versus banks. I don't pay it that much mind. I am at heart a price-to-earnings multiple man. I spent about 24 pages in the soon-to-be-released How to Make Money in Any Market on how brilliant the PE multiple is when you're trying to compare apples to apples. The craziest thing is that Goldman, a fabulous firm, trades at a big discount to the average stock in the S&P 500 because its earnings used to be so episodic. Notice, used to be. This is something that CEO David Solomon has worked hard to change. And this quarter showed how the company's become much more of a well-oiled machine where you're going to get a number that doesn't swing wildly good, bad, or indifferent. I think this is the beginning of when the stock gets reevaluated upward, and the multiple has a giant upward revision, and that's going to propel the stock much higher. Rocket ship.
House of pleasure.
So today, when I saw the stock down at one point this morning after Goldman reported a blowout quarter, a truly blowout quarter, I went ballistic at our Investing Club morning meeting show and said, enough already. When it's down, that doesn't make it bad. When I saw Goldman down 6, I said, someone wanted to buy 100 shares, buy 25 now, buy 25 a little bit lower, and then buy 50. That's called pyramid style of buying. Gradually getting more bigger as it goes down. Why did I have to give that instruction? Because when a stock starts to go lower, it will often keep going lower until all the people who don't know anything are done selling, and you get a terrific price from their ignorance. We saw that with Goldman today as the stock eventually rebounded and finished the session up more than $6. This was their best trading quarter in history, and it's a great trading firm. Very strong wealth management, beginning of a turn in M&A and IPOs. That's really all you can ask for from Goldman, and it's the stuff that's going to make the stock a much higher multiple stock, and I like that. All right, the number of times this kind of thing happens in earnings season is truly insane. People just don't have the time to investigate, so they presume, and very often they get it wrong. Here's what I want you to do. I can't promise that every decline is a mistake. While there are many mistakes made, plenty of stocks go down because they deserve it. But if you own a stock and you see it go down, first check the conference call transcript. Then put it through a chat bot and ask if anything went wrong that you might have missed. I like ChatGPT and Perplexity to do that. The good ones will tell you what lines may have been a disappointment. Ask it to compare Goldman to the others in the industry. If it checks out the way I saw it check out, then the answer is you need to do some buying on weakness. Why? Because the weakness won't last for long. I like to say, as always, bull market summer. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.